Yeah, so we'll get started. Yeah, what do we all do with our money, right? So it's very, very common to everyone. We all earn, we save, we spend, and we also few will invest, right? So out of the money that we are earning, uh, this is what we have been doing, right? So why do we save? So that is something that we don't want to spend today. For our future spending, we will save, right? So why do we invest? Is there a big difference between saving and investment? Yes, of course, there is a lot of difference. So the first few slides, we are going to understand the essential difference between these two, and one should save or invest, or when one should save or when one should invest also we are going to see. Right. So there is a very famous quote said by Warren Buffett. We all know that Warren Buffett is a father of long-term investments or a value investment, you can call. There are a lot of people who follow him. So he says, do not save what is left after spending, but spend what is left after saving. Right. So it looks like a very, very ordinary saying, but it's not at all easy to follow. Right. So this is the same thing that even our parents, our grandparents used to follow earlier. The moment the salary comes or their earning comes, they set aside a money and then they started budgeting within whatever is available after saving. So that is what Warren Buffett is also saving. Yes, one should look at the saving in that way. Otherwise, we keep thinking that, okay, once I earn that particular money, maybe when my income becomes 1 lakh, I will start saving. When my income becomes 2 lakh, I will start saving. No, that's not work, right? If someone is not able to save when they are earning 20,000, they will not be able to save when they earn 2 lakhs also, right? So this is a very, very powerful saying. And one, if it is started following, it's going to be great. They are going to have a great financial life. But that's not enough, right? Saving is alone is not going to help us. What's wrong with saving? See, there is a demand called inflation, right? So inflation, you all must have heard it eats away the value of the money, right? So what do I mean by that? Let's take a small example, right? Impact of 5% yearly inflation on expense. You all might have heard in the news that this month inflation is so and so, and they debate about it. And it's a very big topic in the economics, right? So inflation. So what does it really do to our day-to-day life? Right. So it's not only for the country, it is impacting your and mine day-to-day life also. Okay. So let's say today you are spending about 30,000 rupees, or you are buying something with 30,000 rupees. What happens when there is a 5% average inflation over the next 20 years? Right. So I can even take it as a, maybe this 30,000 is a piece of small ring, a gold ring with a diamond or without, right? So let's say there is an inflation. What happens to it? So the value of it becomes 8 lakhs over 20 years. Look at this. Where is 30,000 and where is 8 lakhs, right? So this is how the inflation impact in our expenses. So if I have to put it across roughly, today, if you are buying with 30,000 rupees, after 20 years to buy the same product or same commodity, you will have to spend about 8 lakhs rupees with the average inflation rate of 5%. Okay. Now we will go back to the savings and see what is the impact the savings make with inflation, right? So I have about 1 lakh rupees of saving. I'm very disciplined saver. I've just kept it as it is. I'm not going to touch 1 rupee also out of it, right? So I keep it like that, maybe in my bank account or maybe just in my cupboard or in a safe locker. I'm just keeping it as it is. What's going to happen to that value? After 5 years, it will become 80,000. Do I say that it's going to shrink? The 20,000 is going to vanish? No, the value of the money is going to be reduced over the period. Over 5 years, it will become 80,000. Over 15 years, it will become 50,000. Over 20 years, it will become 35,000, right? So what does this mean? If I just save my money, the value of it reduces with the inflation, right? So if I have to put it across again the simple way, if I'm earning or having 1 lakh rupee today, after 20 years, if I don't grow this, it will be equivalent to 35,000. You all can relate to it, how much 1 lakh worth 20 years before, if you ask your parents, or you yourself can relate to it. And today, what is the value? This is many people's 2 month salary or 3 month salary or even 1 month salary, right? So 20 years before, 1 lakh used to be very big money. With 3-4 lakhs, people even used to buy home, right? So this is what happened with the inflation. The value of the money goes down if you just save. And the way we spend will be much, much more. We spend in terms of expenses, we will have to spend more with inflation. So what should one do? Savings is not enough. Then what is the solution? Yes. So we have to safeguard our money against inflation. So inflation proof is investment, right? So if you invest in a wise way, probably we will be able to safeguard. So what is the solution? If 5% is the inflation, I have my money, I will have to grow it little above 5% year on year continuously so that my money is safeguarded against inflation, right? So there are definitely easy ways to do it. The first and foremost important thing is start saving early, right? As I have mentioned earlier, there is no right time. You have to wait for the saving or investments to be started. As soon as you start earning, irrespective of the amount, whether it could be 20% of your saving, 30% of your, sorry, 20 or 30% of your income, you will have to start saving. We all work very hard, isn't it? Even on weekends, beyond the working hours, we work, and we should start put our money also to work hard, right? So we have to move to the next step from saving to investing, right? So how is it different? As I told you, it will grow in value beyond inflation, right? When you stay invested for a long time, there is something called power of compounding. It really does wonder. You might have heard in many places that's a major wonderful thing that one can. It will make somebody to achieve anything, right? So all you have to give is a little time. Okay, so rather than just accumulating it and keeping it idle, we will have to move towards investments from savings. So how can one do that? Right. So, I mean, this is again another saying, Warren Buffett saying that never depend on single income, right? So we all work in one place and we earn a salary, or we do business, or we earn income out of it, but that's not enough. There should be always a second source of income, which should come from your investments, right? So how do you invest? Right. So saving is not enough. Investment is very important so that our money will grow beyond the inflation value, right? So how do you invest, right? Goal-based investing. Whenever you do an investment, if you have a purpose in mind, right, it becomes very meaningful. Let's say someone at the age of 30, right? So they can save towards their retirement. They can save towards their higher education. They can save towards their kids' higher education, buying a car, or for your family health corpus, or travel, or buying a home. So this is the ideal way to invest in any of the product. We are just going to see the different asset classes in the coming slides. It could be anywhere. Where you are investing is a secondary. Why do you want to invest? What do you want this money for? All these are important questions that you will have to ask for. So this is where goal-based investment strategy is coming in hand for you. So how one can approach it? Yes, once you choose that, okay, I want to buy a home, or I am saving for my retirement, I have set my objective. So how do I invest? There are a lot of options available for somebody to invest, right? You have gold, you have mutual funds, you have stocks, you have bonds, bank deposits, insurance. There are plenty of options and asset classes available for investments. So how will I choose my investment for my goal? Right. So before you start investing, you will have to ask few questions, right? Does this investment going to grow beyond inflation? Right. So this is the foremost important thing for investment. We have seen that if it is not growing beyond your inflation, there is no point. It is just idle, right? And it should also give you income whenever it is needed, right? So let's take an example of retirement, right? If someone is retiring at 50 for some health reason, it should start giving them income, right? It cannot be rigid like, okay, no, you said you will retire at 60 and the income will start only at 60. No, it should start giving income as and when we need. It should have the flexibility, right? Whenever I need, it should be accessible. Yes, I have been saving for my retirement, but what if there is an emergency? I'll have to take it out for some family members. Yes, it should be usable and accessible, right? I should not struggle and then run around taking my bond and then going towards different offices to realize it. it should grow, appreciate over the period. So when I give long time to it, it should also show some growth towards the money. It should be realizable at fair value, right? Just because I am realizing it, I don't have to give a lot of brokerage, or let's say the value is 1 crore. Because it is 1 crore, I have to give a percentage of commission of 2%, 3% to somebody. And when I'm realizing again, I will have to pay some additional cost. No, this is not fair, because we have been saving, we have been investing, we have been patient and given time to it. When I realize it, it should be at a very, very fair cost, or low cost, or even no cost, right? So these are all the conditions that I will have to check before investing in any of the avenues. So when I ask all these questions, beyond that, I should also look at an important thing called asset allocation, right? So you would have heard people saying that don't put all the eggs in one basket. So what happens when the basket falls? All the eggs will be broken, and we will end up in a trouble. So what should we do? We should do an asset allocation. Asset allocation, I mean, this, there cannot be a better example than this. Nobody can eat only chapati, nobody can eat only vegetables, right? So we need a thali which has protein, carbohydrates, fiber, and everything, right? So asset allocation is also like a balanced thali. So we should have everything in our platter. So we should have almost many asset classes in our investment strategy. So look at this. There are one side you have some avenues or some asset classes which are growing in value, right? On the right hand side, you have some asset classes or instruments which generate income. I'll take an example. Property. You can't see it is giving value. Maybe some property will give you rental income, but it grows over the period. Let's take a plot. It grows over the period. After 5 years, 10 years, people say that it gets doubled or tripled, whatever. It depends on the area and all that. Bonds will give you coupon or interest, right? It generates income. The principal will be as it is. Property, the principal will be growing slowly over the period. Same thing with gold. The principal grows over the period. It doesn't give you any income, right? Art collection, right? So this is a new asset class that is becoming famous these days. It's still new to India, but however, this also grows in value. The older the art collection is, it becomes more precious. It depends on who has done it, where it has come from, and all that, right? Equity shares, yes, this also grows in value. It may give you income in terms of dividends, but majorly the growth happens in the principal, right? So your PPF bank deposit and all that gives you income, right? So it started generating income after you invest, right? You have mutual funds, right? So we have seen in the previous slide, among the different options that are available, mutual fund is something you can be used for growth in the value also, and it can be used for generating income also, right? So if we have a right mix of assets and we choose the right mix with the mutual funds, and it can be provided, it can provide us growth as well as the income, right? So what is mutual fund? So we have been thinking about in the last two slides. This is very good, and one can choose this for growth also, for income also. It beats inflation, all that stuff, right? What is it, right? It is nothing a setup or a trust which gather pool of people's savings who have a like-mindedness, right? Say for example, there are 100 people who have an orientation towards growing their money. They can give about 5 to 10 years. They don't need this money. They are saving for their retirement, maybe for their kids' higher education, whatever could be the purpose, but they have little long term, right? And they have some money which they want to invest, and they want this money to be grown beyond inflation. So this is like a common financial goal or like-mindedness. So all these people together, this pool the money and give it to the trust or the mutual fund company, right? So these people's investable surplus could be anything, right? So let's say in the 100 people, I'm also one among them. I may have only 20,000 rupees. There is somebody who have 1 lakh rupee. There is somebody who have only 5,000 rupees as a surplus. There is someone who have different money, right? So the surplus could be anything. All this money collected is given to the professional fund manager who can identify and invest, who is a master of different types of securities. What are all those different types of securities? You have debenture, you have bonds, you have money market instruments, and you also have stocks, right? So these are all the different securities available in our country. So the fund manager will choose which instrument to invest in based on the investment objective, right? Say, for example, we are going to see that in detail in the coming slides. Say, for example, if someone wants to invest it for just 1 year, right? And they cannot club it with somebody who wants to invest it for 10 years, right? So these people's financial goals are different. So these money to be pooled separately, and this has to be invested in the instrument which is suitable for only 1 year. The same way for 5 years, 3 years, it's different. So the securities will be identified by the fund manager based on the objective of the pool of the investors' financial goals or their objective, right? So this is how we have various categories of mutual fund, right? So the mutual fund gives market returns, but not assured returns, right? So since it is a pool of investors' money, and also it is invested with people's money and in a different instrument, the fund manager will not be able to tell, okay, this is the kind of return that you're going to get and this is a certificate. No, there will not be any assured returns. So it depends on the securities that the fund manager investing in. In the long term, definitely it has a potential to perform much, much better than the other assured return products. So, right, you know, some assured return products like bonds or bank deposits and all that, they give an assured return, but only that is the limit, right? So you, if the certificate says 6%, that's it. There is no potential to earn more. But in mutual funds, there is definitely a potential to earn much more than the assured return, provided you give a longer term to it. And very, very importantly, it's so simple to invest in this, and it is very, very cost efficient from the other options that is available, right? So you take a example of a few other asset classes, you know, the cost of acquisition, maybe in terms of brokerage or in terms of making charges, other commissions and all that. So here it is very, very cost efficient. So this is a basic characteristics of mutual funds. So it's a very, very easy pictorial representation of how a mutual fund works, right? So the investors are all together coming, and the mutual fund company pull the money, give it to the fund manager, and it gets invested in the relevant securities. It could be stocks or it could be bonds, right? And then it generates income. The returns are all delivered back to the investor. So this is how the mutual fund works. And I mean, it's a very simple cycle, right? So why should one invest in this? We've already seen that it could definitely generate much better growth, and it can be a shield for your inflation, and it's very convenient, right? So as I told you, any amount, any surplus can be invested, and it's professionally managed, right? So with my money with my surplus of 30,000-40,000, I will not be able to hire a professional fund manager for myself. So but through mutual funds, I get an advantage of professional fund management and risk diversification, right? So here, when they invest in a security, they don't invest in one security or two securities. It is multiple securities. In that way, my risk is further categorized, and I am de-risking my money by losing the principal or not getting the growth. And it's very well regulated by a regulator called SEBI, Security Exchange Boards of India. So I don't have to worry about, okay, what happens to this? Is it being well regulated and all that? And it's very transparent in terms of disclosing where the money is being invested in, and what are all the costs involved in it, and how much you are paying, and when do you have to get the money, when you invest, where it goes. It's very, very transparent. There is no gray area at all in mutual funds. The most important thing, it should provide income, or it should give the money back to you whenever you need. So liquidity. So it's so liquid, unless you have some lock-in period product, you will be able to get your money within T+3. Now that has also been shortened by another 1 day. So now you have T+1 and T+2 you will get, which means if you want to place a redemption within 1 or 2 days, you will get your money, right? So it's so liquid. So there are so many benefits by investing in mutual funds. Because all these are available, you should choose mutual fund. Okay, then if mutual fund is good and I can invest through that, what are all the categories of mutual fund, right? How it is structured? How do I know that which are all the different categories available? This we have already discussed. Trustees sponsors mutual fund company, and mutual fund companies, the daily activities are all managed by a custodian, right? So SEBI overlooks it overall, and the asset management company is associated with the sponsor and trustees. So this is how the organization structure looks like. And how do they distribute it? You will be able to buy the mutual fund directly also through agents and distributors, through your bankers and fund accountants, and also registered and transfer agents helps them in consolidating the statement and the other KYC related activities, right? So this setup is a very, very sound setup where the ecosystem is created by many parties to provide best services possible to the investors. So based on the different parameters, there are different types of mutual funds, right? So the overall structure, that there are some open-ended funds, there are some closed-ended funds, there are some interval funds, right? So this denotes that how you will be able to invest or come out of it, right? Open-ended funds are available any point in time to invest as well as withdraw your money. Closed-ended funds will have certain period of lock-in. After that lock-in period, you will be able to withdraw the money. Interval funds give you a small window to invest as well as withdraw, right? So maybe there are some funds which are available once in a year, maybe 15 days it is available for investment as well as the withdrawal, right? These are all the categories based on the structure. They take the money and they give out the money. And based on the portfolio management strategy, you have two types of funds: actively managed and passively managed funds. We will see some of the example in the coming slides. Based on the investment objective, so some people wanted growth oriented funds, and you have income oriented funds, and you have hybrid funds, mix of both, right? Based on the portfolio, it is for the security it invests in. You have equity, debt, hybrid, and liquid category, right? Apart from this, there are some special types of categories of funds called ETF, gold ETF, ELSS, your retirement and pension scheme, overseas funds, and funds of funds. We are going to see about this in detail, right? So this categorization, mainly this categorization from 2007 October, these are all the main categorization available in the mutual fund schemes. Equity schemes, very simple to understand. They invest in equities listed in Indian exchanges. Debt schemes, these are all the schemes. They invest only in bonds, debentures, and other deposits and fixed income papers. Hybrid schemes are a combination of both. They will have equity securities also. They will have debt securities also. Solution oriented scheme, they may have anything as an underlying asset, but it is meant for a particular goal. Say, for example, someone is saving only for retirement, only for children education. So this is solution oriented schemes. There are other schemes like an ETF, exchange traded fund, right? So we will also see about exchange traded fund in the coming slide. Fund of funds. Fund of funds is one fund which has other few funds, maybe one hybrid fund and other debt funds and one equity fund inside that, right? So fund of funds will have other equity scheme inside this. So these are all the major categories of funds based on the securities they invest in and the style it has been managed, right? So equity schemes, again, further equity schemes, you know that they invest in Indian equities and it is suitable for long-term growth, and it will be volatile in the short term. One should understand before investing in this. This is suitable for the investor who have high risk appetite and longer investment horizon. And further to categorize, they have in this, they have multi-cap, large and mid cap, and small cap, right? So this further categorization and how the fund should be structured and what percentage the large and mid cap has to be there, it is all being given by SEBI. So that categorization also you can see in the slide. And further equity funds, based on the income that you get, it is, based on the style it is being managed, they are further divided into dividend yield funds. See, they predominantly identify the securities which is giving dividends, right? So that this will get more growth through dividends. Value funds, this is a strategy where the fund manager identify a particular security or a stock which is undervalued currently. It has a potential to perform well in future. Contra is something that follows completely a opposite strategy of whatever is trending in the market, right? Focused fund will have minimum number of stocks, right? We know that equity mutual funds offers us a diversification by investing in more equity companies, but focused theme will have on an average, if other funds have 50 40 to 50 companies, this focused scheme will have maybe 25 to 30 companies, right? Sectoral and thematic is okay. Even in the mutual fund, if a fund is investing only in pharmaceutical companies, if a fund is investing only in infrastructure companies, only in consumer durable companies, these are all called sectoral funds. Thematic fund is, probably somebody who is just following a quant theme or some strategy. So there is some theme that they follow. This is thematic fund, right? ELSS is a very, very famous equity category fund that people invest in, because this gives them the tax benefit under Section 80C. It's called equity linked savings scheme. Majorly, they invest in stocks, and 20% they might also invest in other securities, but 80% will be in stocks, right? So, and this has a lock-in period of 3 years. After that, people will be able to withdraw. Mainly when they invest in it to the extent of 1.5 lakhs, they will be able to avail the tax rebate, right? So equity linked savings scheme, we have just seen that. So this offers them the tax benefit under Section 80C. It dominantly invest in equity, and it gives 3 years lock-in period, which is very, very less than the other tax saving instruments available in the market. Yeah, debt schemes, as the name suggests, these will invest only in the securities, fixed income securities, right? So this is mainly for income generation, not predominantly for growth. This is for somebody who has a low risk appetite or moderate risk appetite, you can call it, right? Again, in debt fund, you have a categories based on the instrument they invest in, right? So from the top till the bottom, if you see, this is categorized based on the liquidity or the from the shortest term to longest term available. Overnight fund, as the name suggests, the maturity of the paper that they have is just 1 day. Liquid fund, so 90 to 91 days. So what does this mean? Is it's not that someone who has 91 days will be investing in this, right? So the portfolio has the papers which has a maturity period of 91 days. Right. At the same way, ultra short duration, the papers will be having the maturity period of 3 to 6 months. Right. So if someone is having 2 months, 3 months, 6 months kind of a time horizon, they can invest in that. Low duration is also suitable for somebody who has 6 months to 1 year time horizon. Money market fund is up to 1 year, right? Short duration fund, if someone has more than 1 year and then 2 years, 3 years kind of a time horizon, they can invest in this instead of other fixed income available. And these are some medium to long term debt funds category available. Medium duration dynamic bond is a combination, right? So they will have short-term bonds also in it, medium-term bonds also in it, long-term also in it, and they keep trading between this. So that's why it's called dynamic bond fund. And corporate bond fund, yes, they invest only in the corporate bonds. And credit risk fund, right? So this name is, as the name suggests, they invest in the companies which have slightly, they have a credit risk, or there are some ratings given to the company based on their stability and how they have repaid their loan and all that. So based on that, the credit risk fund will have the corporate bonds which are rated AA and below. So here their yield will be slightly higher. Yes, there is a slight risk associated with that also, right? The other few categories are banking and PSU fund. Gilt fund is completely or up to 80% they'll have to invest in government securities. Right. So, and in that, there is a further category called gilt fund with 10-year constant duration. So, like this, you have many categories within the debt funds based on the maturity period of the paper that they hold in. So, hybrid is something that is very interesting, and it is picking up a lot of traction these days. So, this is for somebody who have a slightly aggressive mindset, who wants the in growth from the equity also, stability from the debt also. So, it has both the combination. Again, hybrid fund has further category in it, right? Conservative hybrid, balanced hybrid, aggressive, dynamic asset allocation, and multi-asset allocation. Again, arbitrage fund also comes in that category, equity savings, right? So as you just come down in the final one, you can see the category that has been specified by SEBI what is the percentage that it should have it in equity and all that. So majorly this gives you a combination at the advantage of equity schemes as well as the debt schemes, right? So we will see that multi-asset allocation will have at least 3 asset classes, right? So far we have seen only 2 asset classes. The multi-asset allocation can have maybe real estate as an additional asset class, or commodity as a commodity is nothing but your gold, silver, and all that, this as an additional asset class. So all these comes under, there are further categories in hybrid funds. Hybrid funds are nothing but a combination. They will have a combination of assets, equity, as well as your debt. Right. So solution oriented schemes, we have seen this if someone is very particularly saving for a particular event or their life stage, like a retirement fund or a children fund or index fund, right? So this is something very famous. People are talking about it. You might be wondering what it is, right? Index fund are nothing but directly just reflect or invest as it is in the index. Say, for example, take a Nifty as an index. So Nifty is an index, Sensex is an index. Beyond that, you have IT index, pharma index, and all that. So let's take one index. And this fund will reflect the same way and the same proportion how the Nifty is being structured. So that's why it's called index fund. They invest 95% of investment in the securities of a particular index. Fund of fund, we've just saw what it is. So this could be overseas and domestic, right? A fund which is there available in India and people can invest in INR. The underlying fund or the fund that the fund is investing in could be an overseas fund or another domestic fund. So this is an other special category funds, right? So there's some more details about your index fund. It just reflects the index. It aims to provide returns in line with the index, right? And it is suitable for investors seeking returns similar to the index, right? So people are tracking Sensex and Nifty. It has generated so much return, and if I get that much return, that's good enough. So this is for those people who wants a similar kind of return as the index is generating. Index fund is also has got some special advantages for it, right? It has the same weightage as those stocks available in that index. And as it is, mutual fund itself is a low cost product to generate income as well as create more wealth. And index fund are even more cost effective, right? But before you invest it, you should just know, I mean, what is the combination of that and what kind of stocks it is investing in? Is it suitable for my risk profile and all that? But overall, yes, it is a very good way of investing in equity without even thinking much about should I go for large cap, mid cap, and all that. So that's what index fund is all about. And another special category called ETF. So ETF will have some asset class as an underlying asset. Say, for example, there is a gold ETF, right? So someone don't want to invest in physical gold. So they can invest in gold ETF. How does it work is the underlying asset is gold and it is converted into a smaller units, not like not even like 1 gram or 10 grams or 1/7 like that. Even further, it is divided into a smaller units, and that gets converted and people can invest in any of their even smaller amount comfortably. Unlike this mutual fund, other mutual fund category, this is traded in the exchanges, so the liquidity is available. These are passively managed funds. In the initial slide, we have seen active managed and passively managed funds, right? Your large cap, mid cap, and all that is actively managed. Your ETF index and all is passively managed fund. Again, ETF is also available at very, very low cost, and one can invest in gold ETF, exchange, other index ETF also, and it is eligible for long-term capital gains before, after 3 years, right? So in gold, it may not be the same when you invest directly in the physical gold, but when you invest in gold through ETF, if you just hold it for 3 years, after 3 years, it becomes a long-term gain, so that you can avail your indexation and all out of it. So it becomes very tax efficient, right? And no wealth tax is applicable. When you hold so much of gold, there is a wealth tax applicable, but if you are holding it as an ETF, no wealth tax is applicable, right? Another category is international funds. Okay, sitting in India, I also want to take advantage of overseas market. People are talking about NASDAQ, European market. So can I also participate in that? Yeah, you cannot directly participate being a retail investor. There are ways to do it, but the easiest way is invest in an international fund. Right. So these international funds will invest in the listed companies abroad. So equity, ADR and GDR, right? American Deposit Receipts and Global Deposit Receipt, they invest in that. And debt companies listed abroad, ETFs of other countries, right? So like how we have ETFs here. So the other countries' stocks also have ETF that can be in the index, invested. And the passively managed funds can be invested from here. And this also can be invested through fund of funds, right? They can hold some portion of the portfolio and money market instrument to manage the liquidity. All the international fund also hold some of their portfolios in Indian equity. There are some funds, just to give the balance, they have 60% or 70% in the international market. The remaining also they will invest in Indian equity and debt. Fund of funds, we have just discussed this, how this works. So this is also very cost efficient way of investing in something completely different fund. It is not available in India through a fund that is available in India. Arbitrage fund is also a category of hybrid funds, right? So how does it work is, this is suitable for a very conservative investor who wants to make use of the growth that is available in the market. So this mechanism is completely different. So there are two ways the security gets listed. One is the cash or the very security. The other market is the derivative market, right? So they reflect the future potential of the particular security. There is a call option, there is a put option, and there is a future option. But what happens on the expiry day? The value get merges. Right? Say, for example, there is a security which is listed at 1,000 rupees and the future value is 1,015 because they are expecting by this month end or before this expiry, this will go up. Right? What happened on the day of expiry? It will be like if it has become 1,010 and that value also become, the future value also will become 1,010, the spot value also become 1,010. Right? The fund manager make use of this arbitrage opportunity and makes little money out of it. Right? And the arbitrage fund invest in such spot as well as the future market, or there are two different exchanges like this, right? So if someone wants to make use of the volatility of the market but not losing with their money, they want to make some money tax efficiently, arbitrage fund is very much suitable for such investor, right? So there are so many things available. So which one you should you? It's very simple. You have to just understand what is your risk appetite. If you have a higher risk appetite, you want higher returns, equity schemes. Moderate returns, you can go with a combination. You have a very, very low moderate risk, you can go with the debt schemes. If you have a very low risk, yes, liquid and money market instruments will be suitable to you. In a simple diagram, this has been explained, right? So you have risk on the x-axis, return on the y-axis. In debt instruments, so the lowest risk is and the lowest return is overnight funds, and the highest risk and the highest return available in the debt-oriented hybrid scheme. The same way, look at the equity graph. So your equity savings schemes gives you the lowest return, comes with the lowest risk, and your sectoral funds comes with the highest return with max. The risk is, of course, on the higher side, and it is placed in the different place, equity oriented, large cap. So as the risk increases, the potential return also increases, right? So we'll have to ask ourselves what is our risk taking capacity, and accordingly we'll have to choose. Another important thing is, how do I know about a particular scheme? There are three major documents available before you invest in any scheme. Scheme information document, it talks specifically about that particular scheme. Statement of additional information. This is something from the mutual fund company, which is applicable for most of the schemes under them. Key information memorandum is a shorter version of your SID, which can be easily understood by everybody. Not much of effort is needed, and it is available in maximum 1 or 2 pages. You will be able to understand it. Read this, understand these documents before you choose your scheme. Apart from that, you also have a fact sheet which is getting published every month that gives the performance of the scheme, the portfolio of the scheme, the NAV, riskometer, and everything. We are going to see about this riskometer in the coming slides also. How do I invest? Yes, you have direct plans also, regular plans also, right? So the direct plans, you can just invest directly with the mutual fund company itself, and regular plans can be invested through your financial advisor, bank, and your mutual fund distributor, etc. You have different options, growth option and dividend option. As the name suggests, if someone wants the capital to be appreciated, you can go with the growth option. You want dividend in between, you want a cash flow out of it, then you can go with the dividend option. Between this, of course, the growth option has a better tax efficiency. There are different modes of investing. One can invest the lump sum, keep on adding lump sum as and when they have a surplus. One can invest in systematic investment plan. So particularly every month, a particular amount towards the scheme till the time I am able to afford. Systematic transfer is I invest in a liquid fund and systematically transfer that liquid fund money towards a high risk fund, maybe an equity fund or hybrid fund. Okay, so far inter scheme switches is I have some money in liquid fund, I can switch it to the equity fund or vice versa, right? So these are all the different modes of investment, and this is very famously spoken about as a systematic investment plan because it gives you an advantage of rupee cost averaging, and it's very affordable. Anybody can invest. You can even invest 1,000 rupees a month, which is easily affordable money. When I invest regularly every month, I'm able to get the average of it. So look at this example. When someone is investing for a longer term, I spoke about power of compounding. Look at the way how it works. Just 1,000 rupees invested per month, and you are just getting about 8% of return till you are 60 years old, and that's going to generate the value of 5.92 lakhs. The total amount invested is only 2.4, right? And the sooner you start, it's going to give you a lot of advantage. And yeah, so this talks about the power of rupee cost averaging. That is for the systematic investment plan. Every month when we invest, the asset is very volatile. The NAV is available at different point and time, different value, and I'm accumulating at different value so that my overall cost becomes lesser. Right. So SWP is another mode, a systematic withdrawal. So I like how we invest, we can also withdraw it systematically. And how do you invest? You do your KYC. If you have your PAN card and bank account, you do your know your customer, keep these documents and provide your information, complete your KYC documentation, and then you can start investing in online option available, or you can also invest in a traditional physical application mode. Right? How to withdraw your money? So if you have a digital platform, you can just specify how many number of units you want to withdraw or how much you want to withdraw. You will be able to withdraw it. And how you will evaluate the performance? Yes, you have fact sheet available, NAV available. NAV is the net asset value. So this is the indicator, like how much units you have and what is the value of the money and everything. Right. So this is an important parameter to understand the money that the fund that you invest in. So this is being specified by SEBI that for every fund, it has to mention that what is the risk involved in it, whether it is low or high, right? So lower the instrument, yes, the risk is low, which means your principal it is at low risk. And when the arrow or the needle shows moderate, then accordingly your principal it is moderate risk. When it shows high, it is the principal it is at your highest risk. So the one has to refer to this riskometer and the product labeling and then choose their product. Nomination. So when I'm investing, this is my asset, right? And all the units are in my name. What happens in case if I'm not there? Right. So this is where the nomination comes in picture. I will have to nominate somebody. It could be anybody. Yeah, maybe my spouse, my children, my parents, right? By giving their details, the correct details, and providing the nomination to that scheme. And you can choose to nominate different people for different scheme also. You can nominate more than one person also, right? So it is very important to include or give your nomination at the time of investment. right? Even if it is held jointly also, you can choose to give a nomination. And the nomination can be changed in future also. Say, for example, today I have given my father as a nominee, and then tomorrow I can also change my son as a nominee. Any number of times it can be given. As I mentioned it to you, it is very important. There are a lot of complications may arise in future if the nomination is not given, right? If the nominee is given, things could be very simple. At the adverse situation, the units will just get transferred to your nominee. Otherwise, it will lead to a many complicated process. So nominee is important, and giving the nomination while doing your mutual fund investment is at most important. Right. So know your KYC before you start investing in your mutual fund. Complete your KYC, that is know your customer. So you need a passport size photograph, your proof of identity, and copy of your PAN card, and proof of address, right? So it would be your voter ID, passport, or driving license, and also provide your communication details correctly, like your phone number, your mobile number, and your email ID, etc. So this is important to disclose the right details so that you will not have problem in future. Yeah, and also before you invest, please see whether this mutual fund is SEBI registered one. You will be able to see the list of funds that is being registered with SEBI, because SEBI is the body which is regulating mutual funds. I've already told that, right? Security Exchange Board of India. So under this link, you will be able to see all the registered mutual fund scheme. Verify before you invest whether it's a registered scheme. Right? You can also reach out to the compliant redressal mechanism. The number is displayed here, inquiry at ICICIProAMC.com. In case if the resolution was not provided, you may also write to the investor service officer at servicehead@ICICIProAMC.com. For this purpose, Mr. Yatin Suvarna is the investor relations officer of the mutual fund. He can be contacted at the given coordinate. And in case if your complaint or redressal is not solved to your satisfaction, you can also choose to complain it to the SEBI compliant redressal system, which is called scores. They will be able to take the complaint and they will be able to resolve it. Right. So you can also you can log on to scores system. In case if your queries are all not addressed properly by the respective mutual fund company, SEBI will be able to help you in resolving the particular complaint. Right. So before you invest in any of the schemes, it is important to read the relevant documents which I have mentioned in the earlier slides. Right. Mutual fund investments are subject to market risk. Read all the scheme related documents carefully. Right. And also do your due diligence and check whether the scheme is applicable to you, relevant to you, and related documents and all to be read. Then you can take a decision. There is some caution to the investor. This is through from Security Exchange Board of India. What kind of instruments that you should not be investing in, right? There are some, there might be some fraudulent schemes which are not even registered under SEBI or unlisted companies. So these are all the things that one should avoid and read the caution, and then you can proceed investing in your mutual fund schemes, right? So we are done, and there are some important contacts and other dates when the particular caution and all is being listed as here, right? So if you have any question, I will be able to take it. Otherwise, we are done with the session. Hope the objective of the session was met. We learned about savings and investments and why investing in mutual fund is better, the different categories of mutual funds available, how do they invest, and what is the risk involved in investing in mutual fund, which are all the funds suitable for a long term, medium, as well as short term, what is growth and dividend oriented schemes, how they are tax efficient, ETFs, like so many information we have seen through this. However, for your mutual fund and for your goals, whatever is suitable, you will have to take an informed decision. And also you can approach your financial advisor for further assistance. Thanks a lot for being a very patient and wonderful audience. If you have any questions, I can take that.
Okay, I think we can end the session. Thank you.
Thank you so much.
Thank you. Thank you.
Thank you.